Welcome to DeFi Drip, the series where we talk about all things coffee and changing the world of finance. My name is Cassidy Daly, and today we're joined by Martin Quensel, founder of Anemoy Capital and co-founder of Centrifuge. Today, we dove into Anemoy Capital's recently launched liquid treasury fund, and we talked about what makes it different from other on-chain treasuries products and important questions investors should be asking when they're deciding where to invest. Hey, Martin. Thank you so much for joining us on this episode of DeFi Drip.
Hi, Cassidy. Thanks for having me.
So first things first, how do you take your coffee?
Yeah, I kind of trying to reduce my coffee consumption, but trying to do different things now. So typically, in the afternoon, one big mug of filtered coffee, starting the day with an espresso usually, but in the summer also like things like a cold brew dripster coffee, but most likely not that experienced in you, but kind of still, selecting beans and then depending on what I would like to get, also then kind of grind the beans myself, so on. So yeah, it's the usual stuff.
Nice. No, that actually sounds pretty advanced. Sounds like you have delicious coffee. I also really love filter coffee
Yeah,
myself. Nice. Cheers to that. All right, so let's
kind of similar, different cup. Yeah.
yeah.
Cool.
Okay, so we can jump into it. I think let's start out with telling us a little bit about your background for all of our listeners and a little bit about what led to the creation of Anemoy.
Yeah, sure. So yeah, I'm not a crypto person or not the usual crypto person, I guess. Maybe a little bit older than average, but also I think where I was coming from is a bit different. So after university, I started working as a developer for SAP. No one knows that software company anymore, I guess. So that is still creating enterprise software, and with actually my first co-founder for my first startup, who I met at SAP. We created the SAP payment program. So I guess still most of the big companies, Global 2000s, being paid with some code I wrote back in the 90s. So yeah, and then from there, I had my first startup that was kind of bootstrapped, uh, was process automation, so rather boring things, and pretty much connected what I did with SAP. And then from there I jumped on a journey where I think I really left more and more the the process automation, really deep software development corner, and turned more and more into a, would most likely say, a finance person. So after the first company was called Aave, we sold it to a Swedish company in mid 2000s, and then was Taulia. It was a Web 2 shop, which was creating a network, of course, permissioned and closed, so old school, for trade finance, where we connected the network to the biggest buying corporations on the planet, things of a Vodafone, an Airbus, a Pfizer, etc., and allowing their suppliers, thousands of suppliers, so also the small suppliers, to accelerate payment and to receive the payment earlier. And it was pretty new back in the day, so that even the Christmas tree guy at Christmas could get paid earlier, which was impossible before. Yeah, that was also a nice exit to SAP, and then we finally founded Centrifuge, and you were part of that journey pretty much, and now Anemoy. Yeah, so we are, Centrifuge. I think the idea behind it was that what blockchain and for most smart contracts can do in the future is most likely creating a permissionless, completely distributed and decentralized financial system of the future. And where we, the Centrifuge, wanted to contribute a few things, especially if it comes to credit and how credit is observed, structured, and distributed from investors to borrowers, that I think much more efficient would be a blockchain-based system that is automated and which is removing the usual intermediaries and reducing it to, I think, what is really needed to make it work at one end, and also creating a global credit market, which is transparent enough at the end, of course, much more efficient. So that's what we see with all the markets. As bigger they are, as better they work. And then I think later on the journey, I think I realized that this way is most likely much more complex and much more difficult than everyone thought in the beginning. So everyone is talking about now about real assets. We at Centrifuge were most likely the first, or one of the first projects really kind of delivering on that with first tokenized assets and the cooperation we had with Maker back in 2019, etc. But if you look at from what has happened since 2019, it was actually surprisingly less. Where all the big shops like Larry Fink recently again speaking about tokenizing assets, and that tokenization is the future. But what is really happening in real life, what is really delivered, it's almost nothing. If you look at real assets, currently it's a handful of DeFi protocols actually delivering tokens to a complete new user audience, rather than kind of replacing existing markets. That's what I'm seeing today, and that is exactly the reason why I founded Anemoy, where I think the technology also needs to be presented in an institutional grade quality, so that the transparency and most likely the real time permissionless capabilities of blockchain being combined with the good old risk management and structuring skills, and that actually those, I would most likely say, traditional and decentralized finance skills need to be combined in a way that it's actually something a traditional, or I would most likely say a professional investor with an understanding of the underlying would like to use. So I think where the current offerings are going to people who know what a token is, how blockchain works, and how the technology works, but which have a limited understanding on the underlying, the assets, the risks, and also the structures it's coming with. So they most likely do not really know what they invest in at the end.
That's a really interesting professional journey. Definitely non-traditional.
Thank you.
And I think that's probably part of what makes Anemoy different from traditional asset managers. I'm curious what you think makes Anemoy different from some of the other asset managers that are out there.
Yeah, I think Anemoy is different. It's really a technology-first approach, and a decentralization, DeFi, Web3 first approach. So where I would say, hey, blockchain first, and whatever we can do on the blockchain, we would offer it on the blockchain. Where most of the others are either completely permissionless. I come to that in a second part of that answer, I guess, or almost, actually fighting with the traditional finance issues, but without regulation. I think what we had called CeFi and had seen failing in 2023 on scale. Everyone remembers, I guess, the last crypto winter and what it had cost. So yeah, I think where Anemoy is really different is really being at the edge, being at the frontier of using the technology on one end, but on the other end, do that in a permissioned way and using structures which make it interesting for institutional investors. So that's why our first offering is what everyone knows, and most likely say, not this again. It is tokenizing US Treasury bills, but the way how we did that is different than most of the offerings you see out there, and where I think we can also kind of differentiate ourselves.
Yeah, by the way, congratulations on launching that first product.
Thank you.
Yeah. And hopefully we get a little bit more into the details on what makes that different in this episode. But first, I guess to start off in that direction, why did you decide to start off with tokenized treasuries?
Actually, where I've seen, if you launch a financial product, you of course would need a financial product which finds a user base, and the user base here is obviously investors. So a financial product without an investor wouldn't work. And when we launched what we call the Liquid Treasury Fund at Anemoy, we thought about what is actually a investor base which is not served well yet. And looking at the current offerings, I think there is no T-bill offering which has really institutional quality. But there is in the space still, or already, I would most likely say, a set of investors who have a strong demand for institutional quality. And I think, and that is also what we had welcomed as investor already and about to onboard. These are DeFi institutions, I would almost call it, decentralized autonomous organizations who have the capability and also the personnel and the experience to act as a professional investor. Our first investor, we had a nice press release, was Web3 Foundation, and Luca Basili, the kind of man behind this investment at Web3 Foundation, has a traditional treasury background. He was a banker and did treasury management for DeFi, I think, for like 15 years, if I'm not wrong, and is now in the DeFi space. And he really did a due diligence like any other professional institutional investor would do that, And finally, then at the foundation, also a credit committee or investment committee got that proposal and then finally decided to invest. So, and I think those investors, they are not served well before and looking for offerings like that.
So it sounds like this institutional quality is one of the bigger differentiators between Anemoy's Liquid Treasury Fund offering and other treasuries products that are on chain. Are there any other qualities that you think really distinguish Anemoy from the other products that investors can find out there?
I think if it comes to Anemoy and how we structure it, most likely not. It's more the combination with the technology we are using. So talking about Centrifuge and the Centrifuge protocol here, where I think that the only protocol which is really built for real-world assets from the ground up, and where you see end-to-end in a very transparent, almost real-time way how a single asset is performing, how that is impacting a pool of assets, and finally also the share actually an investor is holding of that pool of assets. And I think this way of kind of how you basically see, hey, I'm holding a token. The token is a participation in the pool of assets, and in this pool, I can actually check every single asset and every single asset's performance, including the history and the past performance of assets in a revolving evergreen structure that is novel. I think that's the only protocol which is doing it in this way and in this level of detail. Then one thing, the second thing is most likely we are different coming to the audience we are addressing. So DAOs and DAO treasuries. Most of the DAOs in the DeFi space, they come with an own product and an own purpose. So Web3 Foundation, obviously, that's simple. They're the foundation behind Polkadot and the ecosystem they are creating. But a lot of the other treasuries also coming with something like their own technology stack, their own ecosystem they would like to support and promote. And the capability Centrifuge is offering to support not a single blockchain, but also acting as a cross-blockchain protocol and creating, I would most likely say, a global pool of liquidity that is unique. So we had welcomed investors already from Ethereum, for example, from Polkadot itself. Next investor most likely investing through Celo, Arbitrum-based Gnosis, etc. What the DAO has on a roadmap, and that is serving well to the purpose of actually that a treasury can actually not just invest in institutional grade quality, but also supporting their own ecosystem.
So it really sounds like this integration between Anemoy and Centrifuge is what creates the best product for these users.
That's how I see it, exactly. Also, the reason that I would most likely say, hey, that's why we had created Anemoy, is really to fill the gap, because technology is not what it as an ecosystem gives us ultimate success. It needs also the contribution from finance players, and also most likely, some of these things you cannot really decentralize yet. We have still regulation, we have still a real world we are connecting to, and that is regulation maybe is decentralized in one point in time, but that's most likely another podcast. But real world assets will stay real world assets, will stay in the real world, and disconnection will be most likely trust minimized, and we are maybe able to minimize the trust in a single party who is owning or controlling those real world assets. I also most likely can expand on that a little bit later if you wish, but that is it will never be a trustless as a crypto asset. A T-bill will never be a Bitcoin. There's just a different nature of an asset, and that's something we will not be able to change. I think we will be able to come to make it work for the decentralized purpose and what we are looking forward, but it will never be as decentralized as a Bitcoin or an Ether or any other crypto asset.
So let's dive into something that you mentioned already. So you said you started onboarding your first users, and it sounds like this early demand is coming from DAOs as the first movers into investing in treasuries on chain. I'm curious why you think that is, and what do you think it is about DAOs that makes them really interested in Anemoy as the product of choice?
Think of a person who has an years-long background in traditional finance and really does the do your own research in the three stages, which I would most likely call the why, the what, the how. And why is most likely, hey, we have idle money and we would like to invest it. And then you most likely need to look at how much you would like to invest. What is your investment horizon? What are the risks you would like to take, et cetera, et cetera. Is really most likely reflecting and create something where I would most likely say, hey, that is my internal investment thesis. An investment plan as a DAO treasury, for example. The next one is really what, and then parts of it is maybe T-bills, because if you look at T-bills, it's one of the most common investments you can make. I would consider it safer than a bank account. The counterparty risk, if it is structured right, come to that with a how, is the US government. So, hey, as long as there is a US dollar and the US dollar has a value, that investment is safe. And then lastly, the how you invest in an asset like treasury bills. And that is where Anemoy is different. And where I think we can really differentiate ourselves. And that is starting with what is a counterparty risk? So what is the token representing? And I think with Anemoy, we have introduced a novel structure where the token itself is a token as a fund share. So maybe let's take a step back. What Anemoy has really done if it comes to T-bills. So very traditional infrastructure to buy and hold T-bills. So that's done with a prime broker, Wall Street firm, everyone knows, and a custodian who is holding the real world asset treasury bill. Of course, it's digital, but it's not a token. It's not on the blockchain. So that's still living in the traditional financial system, and that needs a custodian. So that is also a very traditional setup with a Wall Street custodian, most likely everyone knows. But on top of that, I think that's where the difference is starting. So Anemoy had created a fund on the British Virgin Islands, and the BVI-FSC as one of the few locations or jurisdictions on the planet allowing the tokenization of such a fund. First of all, it's regulated, so there is a local financial regulator who is actually requesting Anemoy to fulfill a few things, like the things I've already mentioned, but also fund administration, fund audits, etc., making it bankruptcy remote, and so on. But finally, also the ability that the fund shares can be issued as a token. So number one, the token itself gives you ownership. With the token, you own a share of the Anemoy fund, and with this, a share of the underlying assets, the T-bills, and that is novel too. With this token, you can do a redemption in kind. What is a redemption in kind? Is if Anemoy is not able to serve a redemption request, so you give me your token and I give you a stablecoin as an investor, you can go to the custodian or another service provider and request a redemption in the physical T-bills. Of course, that's not on-chain anymore, but as a last resort, that's still something where with the token, you can claim the underlying T-bills. Most likely getting paid in traditional dollars, not stable coins anymore, but the money isn't lost. So that is, I think, one of the things it's adding. And the next thing it's adding that it's actually the token itself gives you a regulatory safety. So what I think it's most likely, first of all, the counterparty risk. That's what I try to kind of discussing first here. This token providing you ownership, but the token actually without Anemoy, you can even, the token has value even without Anemoy. That is where you mitigate the counterparty risk of Anemoy. And in most of the other offerings, you have a counterparty risk, an SPV, whatever the structure is. But the counterparty risk is basically not the US Treasury Department and the T-bills. It's an intermediary in the middle, like in ETF, it's unlikely that it is. But if you would not buy a T-bill through Treasury Direct or whatever directly and hold your T-bills yourself, but go to BlackRock, which is most likely the most common way for a traditional investor, and buy an iShare there, your counterparty risk for this ETF is not the US Treasury Department, it's BlackRock, and of course your BlackRock is most likely an institution you can trust. In all these token offerings you see out there for T-bills, all novel players like Anemoy are all super small compared to the decades of experience and the trillions and BlackRock has traded, hold managed, etc. Tiny nitty-gritty early days, and again, counterparty risk is not T-bills. With Anemoy, you come very, very close to that. The counterparty risk is T-bills, and it's a direct investment in T-bills. And the second thing, sorry for the detour here, is that the token itself is actually issued in a very regulatory, very safe environment where we need to follow the BVI FSC regulations if it comes to KYC AML, so that holding the token itself will not cause any issues. If you hold the token, so with a permission nature, but also that the way how we actually manage and issue the permission token is regulatory compliant, that is important to protect yourself from those most likely regulatory risks you have seen. With an extreme example is Tornado Cash. If actually regulators see this token as a tool to launder money, a breach of AML regulations, they may sanction it. And if they sanction it, maybe your wallet, even if you are a valid investor, you wouldn't have any issue as an investor to go through KYC AML, because everyone else, I don't know, North Korea or whatever, just as an example, had invested and held the token and received some yield from that product, that the entire product is shut down, but also that actually your fund's being locked, that maybe your wallet is sanctioned because you traded with it, etc. I know that is another threat. I think most of the investors currently don't really think about, with the exception that more institutional investors, of course, also have that in their due diligence.
Yeah, so DAOs, being a bit more like institutional investors, are thinking about these types of questions. So you went over questions like, what is the counterparty risk? Is this entity regulated? What is the token actually representing that I'm holding? These are all things that, a DAO, being a little bit more like an actual institution, is interested in finding out these things. And I think, other users that are looking to invest in real world assets on chain are going to start asking some of these same questions, right? And DAOs, being, the institutional grade investor here, they're probably going to lead the way, I guess, for everyone else in really trying to dig into these things. I guess I'd want to, dive into that maybe a little bit more. So you mentioned, what is the token representing? Um, who is the real counterparty here? Are there any other legal questions that you think are important for investors to consider or maybe get overlooked when it comes to these on-chain products that you think is really important that distinguishes maybe something like Anemoy versus other on-chain offerings?
Yeah, so what a professional investor thinks if it comes to the how is really most likely what is the worst case scenario, and then trying to understand the structure from me investing and holding a token into what is the underlying real world asset and what is the connection between the two and can actually happen worst case. So, it's fraud, someone tries to run away with the asset, someone tries to run away with the money. The other risks I already mentioned. So there is, of course, more. What is a token representing? What is actually the regulatory environment it is issued in? But I think there is also, that is including counterparty risk, etc. But also, what are the other intermediaries? What are the service providers you are using? Finally, of course, also not really connected to it. What is the fee structure? What is actually the service fee I need to pay for, and etc. And then, if you look at a structure, typically as less complex, as less straightforward is better. So, reduced number of intermediaries, less or fewer connections between the asset and the token, and also putting it transparent on chain. And this combination, I think, is something only Anemoy is offering in a institutional quality. And it's most likely, if you would dig deeper, we most likely could talk hours about it and how others are different, and where I think we're actually novel and most likely late at the table, but having substantially better offer.
I mean, maybe just to summarize on that aspect, like, are there other technical aspects that you think are really differentiators for Anemoy and questions that users should be asking in terms of things like what blockchain it's on or like what kind of smart contract risk there is? Are there any other things that you would point out?
Yeah, I think you mentioned it already. So hey, is the protocol, is it audited? Is the code public? Can I check GitHub? A second opinion, what is the history of the protocol? Where Centrifuge, I think, went live in the first version in 2019. The current version on Centrifuge chain was launched, I think, a month ago. It's all public, it's all open source, it's all audited, and it's also something they can already see traction and not only a single user using it. And I think also what feels, at least for me, important to work towards decentralization, that if you look at Anemoy, definitely a centralized player, definitely an entity which needs to be regulated and is holding licenses, etc. And that is something you should not connect and commingle with the underlying protocol. That's also why I stepped out of Centrifuge in my capacity as a co-founder, founded Anemoy, and now turned myself into a real DAO member and contributor to the protocol, but not participating in the development of the protocol anymore, where the DAO itself is creating the infrastructure, but someone else like Anemoy, and I hope many more, using the infrastructure, which I also think is an important aspect. That's not, a single party owning everything end to end, owning the technology stack on and off chain, and it actually kind of turns again into a single point of failure. What you have seen last year, if this,
One hot topic on that technical aspect is permissioned versus permissionless tokens when it comes to investing in these tokenized treasuries. What's your take on that?
Yeah, I touched on it already. I would most likely see that as different user bases currently. There are obviously those yield-bearing stablecoins, USD something, which has an underlying investment in T-bills, but obviously how they are structured The token is not even remote. The T-bill risks, there's a lot of intermediaries and levels in between, which actually create a completely different set of assets. It's still not generating much more than T-bill, I need to admit. But on the other hand, I think it's for the users actually how easy they can actually access it. And they're a permissionless way. I just connect my wallet with the protocol, send my stable coins, receive the token is the easiest way what you can do that, And I think most likely for less experienced users, who do not want to invest a lot of time and efforts in due diligence. They most likely do not care too much about the risk. They just most likely follow the masses, where they say, hey, if a lot of other people have just invested in the token, the market cap seems to be all right. I also would like to kind of check it out. And I hope also they most likely do not put in a fortune, just, keep their portfolio diversified and just park some money there, but not all their dollars. But that is really, I would most likely call it a retail, less professional investor audience, whereas Anemoy is clearly focused on less but much more professional investors. So we see also a single investor with at least coming with 500,000 US dollars in stable coins. That is something where in permissionless protocols, you most likely see thousands of investors with smaller numbers. And we look at with a permissioned approach to most likely much bigger but smaller investor numbers. So that's one differentiation. But on the other hand, it's really there, of course, coming back to institutional grade, coming back to a product which is coming as close as possible currently to T-bills and the risk T-bills are representing. And that is, I think, the differentiation, what you like, easygoing and more risky, or you actually do not really know and understand the risk, or I completely understand the risk, but I also need to follow a compliant route and do KYC and AML.
So it sounds like professional investors that want to avoid the risk are really going to start looking more towards permissioned in terms of these types of assets.
If you look at regulation, as bad as this and as less I like it, is what it is, all the regulators around the planet actually, of course, following a permissioned route. So I think the best thing we can do to keep it at least decentralized, that the infrastructure is decentralized, that the infrastructure isn't governed by a single person and not creating another single point of failure. That needs to be a decentralized protocol like Centrifuge, but then the players using this infrastructure need to follow the regulatory requirements, unfortunately, and that is including AML and KYC. Yeah, and also MiCA and European Union, what is happening in Asia. Also, the first ideas discussed in US definitely only, unfortunately, see a permissioned issuance for tokens representing real assets.
So we touched on a lot of different questions that professional investors are asking themselves when they decide to invest in Anemoy's product. So we talked about some of the technical aspects, like this permissioned versus permissionless, whether these protocols are audited, some of the legal questions, like what these tokens are representing, who's issuing the token, are they regulated? I think one of the other interesting things that Anemoy is looking at in the future is being able to expand beyond treasuries. How important do you think that it is for products like, what Anemoy is offering to be able to offer that to their users?
First of all, really, differentiation, diversification is super important. And I think T-bill is just the first step for us to enter into that market and have a trustworthy and institutional grade token offering. Because T-bills are super to understand. It's also the right time to invest in T-bills, looking at the market. And that might change, it might even change this year already with interest rate cuts and another interest environment. And that's where we also want to be prepared and have other new offerings. Where actually the people already have understood the structure and that we're actually using the structure, a tokenized fund share, to replicate that with other underlying assets. So most likely looking at CLOs, looking at corporate bonds in the future. So we're looking at existing financial instruments which are well understood, which have a secondary market and which have immediate liquidity, but higher yielding. That is most likely the next step we are approaching and also already undertaking. And following that, I think the big dream I'm dreaming is still, and that's I think why we have founded Centrifuge, is that I think credit should exist on chain, and that every credit or every financing should actually be structured through the blockchain. And if you look at the current markets, maybe coming back to Thalia, one of my legacies, trade finance, so the global trade is somewhere around 30 trillion. That is only the trade between countries. So, that is including, of course, Apple buying from an OEM like Foxconn an iPhone and selling it as an iPhone. That's including it, but really only cross-border trade is something like 30 plus trillion US dollar, and not even 10% of it is yet financed. And the issue here is really that there is no real structure, no real infrastructure to do that, and tapping just in that market for trade finance is just a multi-trillion-dollar opportunity, not even speaking about all the other asset classes, project finance, if you would like to build, I don't know, a solar power plant, the carbon market, the carbon offset market is just a huge opportunity, etc. Where I think DeFi cannot be just change the financial system as we know it today and be most likely less value extracting in the future and much more efficient, and give their size doesn't matter that much as it does today. That actually a deal needs to have a size that it's worthwhile for a bank to execute. If the blockchain is automating it, it doesn't matter if you finance $10 or 10 billion. That's most likely one of the things it can develop, but also it can support. But I think it's also a super important opportunity for us in DeFi actually to provide the money for what's really needed to save the planet. So I know it's a big word, but I would like to be part of that journey.
So you mentioned a couple of things here that I think are really interesting. Like interest rates won't stay high forever. So we're going to start seeing a lot more different opportunities coming on chain, specifically credit. And also that DeFi in doing this is bringing a lot of efficiency to that. What do you think between those two things is really going to be the biggest driver to bring institutional investors on chain?
I think we will most likely see over the course of 24 two movements. Traditional financial institutions, like, if you just listen to Larry Fink recently, so I think BlackRock had that on the agenda, but also many more banks, most likely every global bank. So a few things they will do. They most likely will either use an existing trust versus stablecoin, but more likely they may even introduce their own stablecoins. You can already see that in Europe, and MiCA is the first regulatory environment where you know how to actually issue and set up a stablecoin as a bank, for example. So where I think a lot of the major European banks may come with a stablecoin in 24, their own most likely euro, whatever based stablecoin. So I think, they will, first of all, most likely heavily develop the stablecoin infrastructure, most likely with their own stablecoin. And second, most likely bring their own assets on chain. I think that sounds nice, but the only thing it's actually doing is that it is making the trading, the holding, buying, selling of assets much, much more efficient. And that seems for them good enough. I think on the other hand, DeFi is going deeper. It really would like to apply the tools which we had built for crypto and crypto assets to also those traditional real world assets. And that is not just, buying and selling and transferring it. It's really pricing oracles, kind of structuring it, pooling it, distributing it. There are so many things. If you just look what we had done in crypto from a first IPO and a token being issued on a blockchain to where DeFi is today, I think that will happen in parallel, and most likely it will. I don't know how long, but most likely it will take years that both threads will merge. That I think TradFi, as we know it, will most likely turn into more and more regulated CeFi. And that then these new kind of CeFi players uh, will really turn into DeFi or being merged with DeFi, that is most likely which will take much longer.
What role do you think DeFi native players like Centrifuge are going to play in this?
I hope a substantial role, but where I think we most likely are less competitive to a traditional financial institution in the coming month, maybe 1-2 years, for a reason that they do what they do with tokenization and we do what we do, and that we most likely focusing on new markets. So either new investor classes, like hey, there's no reason for an existing investor to buy an Anemoy token. Hey, they can go to one of the TradFi players or directly open a Treasury Direct account and buy the T-bill there. That is definitely already a DeFi or DeFi driven audience. That's one end. And on the other, I think also long-term different asset classes traditional finance isn't able to capture. And that value will be unlocked. And again, back to my trade finance example, hey, there is less than 3 trillion financed, more than 27 not. I rather focus on a 27 and unlock that potential than fighting with others on the already existing $3 trillion market, and that's, I think, where DeFi will win, outscale TradFi, and then finally it will merge and, of course, disrupt the industry as we know it.
That's really exciting. I think that's a great note to end us on. I think I want to thank you, Martin, for joining us. This was a really great
Pleasure.
conversation. I want to wrap up with one last question that we like to end every episode with. Can you share with us one of your hottest takes?
My hottest takes?
Yeah.
It's I most likely should have listened more to the recent podcasts. Let me think about it. No, I think there are if you just think about decentralization and blockchain, it's most likely falling too short. I think long term, the world will not be automated through blockchain. The world will be automated through AI, but blockchain will be the tool to control it.
Nice. That's a great note to end on. Pretty controversial. Would love to hear responses to that one. Thanks so
Thank you.
much for joining us, Martin.
Yeah, pleasure. Bye.
Bye.